A Texas-based subprime auto lender just shocked the banking industry by filing for bankruptcy. And right now, the banks are scrambling to get their collateral back before it's gone. But my friends, this is just the beginning, as you're about to see, because I've been warning for years that the next subprime crisis is going to be centered in the auto industry, and now it's just beginning. And this is getting the attention at the highest level of the banking industry. We're now hearing from JP Morgan Chase and BlackRock that's raising concerns that the pain in the multi-billion-dollar market for bundled auto loans is now just starting to mount. And let's take a look at what happened and why it's going to get a whole lot worse and fast. Just hours after reports emerged late Tuesday of an alleged fraud scheme, Tricolor Holdings filed for bankruptcy and said it plans to liquidate, marking the latest and most painful blow yet to a risky lending business that's been buffeted by a surge in interest rates and weakening jobs market. Now, the key point here, it's not about interest rates. That's the issue that everybody wants you to believe, particularly the Federal Reserve. The real issue is the labor market. Now, federal prosecutors are now looking into allegations of fraud by Tricolor. Now, look, it's not the kind of fraud you're thinking. If it's lending fraud, well, it's going to be in a different way. Let's take a deeper look. Because in those warehouse lines, or what are called temporary credit lines, where the alleged fraud is said to occur, with lenders now questioning whether the same collateral was pledged to back multiple facilities. But I want you to see there's been no mention of fraudulent lending practices here, and that's a big red flag, because you might think, hey, if they're filing bankruptcy and they're seeing a wave of delinquencies and defaults, well, then must be an issue with the lending practices. Not at all. In fact, that's not an issue to begin with, and I'm going to show you why here in a moment. As a growing number of low-income borrowers have struggled to make their car payments, the bonds backed by those loans, which are known as asset-backed securities or ABS, have begun to show cracks. Now, I want you to think back to the housing crisis, because remember, we had mortgage-backed securities, and what happened? As the economy slowed down and people started to fall behind on their mortgages, because in many cases, people just didn't have one home, they had multiple homes they were making payments on. What happened? Next thing you know, the delinquency rate started to rise, cracks started to form, and then next thing you know, there was a cascading level of failures in the lending industry. And after President Donald Trump's push to deport millions of undocumented workers, many of whom borrowed legally from Tricolor and firms like it, is only adding to those pressures. So we're seeing two issues here in the labor market, particularly stemmed in Texas. Now, I wanted to go back just briefly to last week. Remember, there was a spike in unemployment claims? Well, it turned out that was fraud claims. And now we're finding out that, hey, a lot of these lenders are having a problem, because if people don't have a job, maybe because they got deported, they can't make their car payment. And that's a huge concern, but it's not the primary issue here. Because when you think about the broad economy and you think about how this is going to blow up and not be an isolated incident in Texas, you have to think about the labor market. Now, you might know this is one of the reasons I'm so focused on average weekly hours of people that are working, because it's all about the labor market. And as we see hours worked go down, well, what happens is the delinquency rate goes up. And when people lose their job, it gets even worse. Let's take a look at this chart of the delinquency rate on credit cards against average weekly hours of production and non-supervisory employees. And I want to put some perspective on this, because you can see going back into the 90s what happened. Average weekly hours decline, and instantly you see the delinquency rate rise. The same thing happened going into the dot-com bubble, and you can see it very clearly during the financial crisis. And then you can see pockets of it right around 2015, 2016, and even going into the pandemic. And you go back to 2021, and we know the U.S. economy was decelerating. How did we know it? There was two key indicators here. Delinquency rate was rising, and it's all because average weekly hours were falling. Now, the bigger issue here is the fact that we talked about this in yesterday's show. We're seeing imports start to drop, and we know that as imports go down, it's going to affect the hours of a lot of workers. We've talked about the housing market. As it slows down, it's going to impact not only people directly in the industry, but all the way up to the manufacturing level. So this is going to have serious implications, and this is why I'm so focused on that weekly hours data, because what it's suggesting is this Tricolor incident is only the beginning of what's to come. Even if the subprime auto market blows up, you can still make money in the markets. Let me give you an update on this trade we put on D8PP back on the 10th, now up 15.67%. And this was from our optimized meta strategy that went out to all of our subscribers. Now, I'm in the process of changing the way people trade, showing you how to put more money in your pocket with better trades. Now, how do you get involved in this? All you have to do is grab those links in the description below and use a coupon code for your free 30-day trial. Stay tuned to the end of the show to find out how you can take advantage of this meta strategy and make money in the markets. Now, investors have piled into the subprime auto market, swelling its size to some $80 billion, set to reap the kind of interest rates a few debt products on Wall Street offers. And now you start to understand the real issue behind this, why there's no fraud in the lending side. It's all about the collateral side, because Wall Street loves this stuff. And if you think back to the mortgage bubble, why was it so easy for people to get loans? In fact, you may remember that you didn't need a job, you didn't need anything, you just signed a piece of paper, and next thing you know, you got a mortgage. It's because there was so much money chasing it that what happened is lenders just started to lack standards until they could meet the demand of Wall Street. But the problem is, the demand from Wall Street was so high, they just kept giving away mortgages. And that's the problem we're seeing in the subprime auto market, is that people that probably had no business getting an automobile or had no chance of making the payments are getting loans. You know, I actually had a friend that worked in the auto industry for a brief bit, and he did a lot of subprime loans. I asked him why. He says, well, it was easy money. He said people would come in, no one wanted to talk to him, and he said, I did. And it turned out, well, their employment was marginal at best, but we would lend to them, and we put them in a new car, knowing that they wouldn't likely make the payments on it more than a few months. And I asked him, why did you do it? He says, well, I had nothing to do with it. The banks were willing to lend. And he goes, Steve, the banks were charging some 20 to 30% interest rates. And now you start to understand why so much money was funneling into this. ABS market participants are creating incredible demand for subprime auto loans, and this is resulting in loose and sometimes even reckless underwriting. And while tricolor bankruptcy may seem isolated and idiosyncratic, one would be remiss not to ask whether or not it's a canary in the coal mine for subprime auto lending. And my friends, it is. It's all about demand. And the problem is, since 2021, demand continues to weaken. And prices for almost $2 billion of debt behind subprime auto lender Tricolor Holdings suddenly collapsed yesterday, leaving creditors across the U.S. scrambling to stake their claim on companies' remaining assets and contain their losses. Check this out. In Dallas, the regional bank Triumph Financial has dispatched teams of employees to use car lots where they're identifying and whisking away to safe locations of vehicles they believe are collateral of their loans, because they're concerned that those vehicles may be collateral to multiple loans and they want to get them back first. What you're seeing here, my friends, in the auto industry is what's called a margin call. In Midtown Manhattan, a boutique investment firm that built a position in Tricolor's asset-backed bonds, Clearhaven Capital Management, has been calling for other bondholders, urging them to band together and fight to keep the banks away from the assets that belong to them. So you can see right now, these lenders are saying, look, we don't know whose collateral this is. We think it's ours, but other people may have a claim to it. So we're going to go get it and park it on our lot and let them fight us in court to get it. Now, let's talk about why this is likely to get worse and fast, because the Wall Street Journal noted earlier this week many young people have borrowed to buy cars during the pandemic when they didn't have to make student loan payments. Now they're struggling to repay both. Auto delinquencies and car repossessions are getting closer now to 2009 recession levels, and yet, arguably, based on the stock market, you would have no indication this is happening. But again, as we've talked about, the real economy is weakening. It's not just subprime. We see car buyers with above average credit scores are twice as likely to fall behind their payments as they were before the pandemic. And we've been talking about how the issues of the economy weren't just for low-income Americans. They just filtered up into the middle class. And in some cases, high-income Americans are falling behind on their car payments and credit card loans. And younger buyers in particular are hitting the payment skids in high numbers, and the repossession rates across all age groups jumped by 43% between 2022 and 2024, this according to Cox data. Let's take a look at this estimated auto loan default rates, and you can ask yourself, why are auto default rates rising since 2021? My friends, it has everything to do with weekly hours. And you think about the impact this has on younger workers. Well, what's happening as the economy slows, you're seeing employers say, look, we want to keep our skilled workers, our longtime workers. We're willing to get rid of our younger workers here. And the problem is the government knows this is a brewing crisis. Let's turn to the Consumer Federation of America, who says borrowers are experiencing significant difficulty staying on track with their auto loan payments. The percentage of auto buyers with severely delinquent debt, defined as 90 days past due, is at its highest since the peak of the COVID lockdown, and before that, the Great Recession. And late-stage delinquencies increase across all credit tiers, led by the VantageScore Subprime and VantageScore Prime segments, according to the latest edition of Credit Gauge published today. Credit delinquencies over 90 days late were up 109% year over year in the subprime segment, while the prime segment saw a 47% increase year over year. Again, this is affecting everybody, and that is the problem right now. And some of the reasons why this is likely to get worse is because the economy, again, is continuing to slow down, and it's been slowing down since 2021. This is why we look at the import data. This is why we look at the manufacturing sector and the real estate sector, and what are we seeing across the board? That everything is continuing to slow. We have too much inventory and not enough demand, and the problem is because of rising prices and shrinking paychecks, consumers at every income level are falling further behind. And as that happens, well, next thing you know, what people can't make payments on, that turns into delinquencies, and that rolls right into defaults. And while the experts have hoped for a plateau and a rebound in the economy, I've said the exact opposite is likely to happen. And we've been hearing from the consumer sentiment surveys from the Conference Board and University of Michigan that workers are under financial stress. They're worried about their jobs. They're even worried that if they lose their job, they're not going to be able to get another one. And what this is all setting up for is spending to decline, savings to go up, and this means hours worked going forward are going to drop. And we're even hearing from businesses that are saying, look, we already know holiday spending is going to decline. This is going to lead to further layoffs, again, further hours cut, and you're going to see this thing start to spiral. And if we look at the energy sector, you look at what's happening in the oil and gas producers in Texas, this is an exact example of what's coming for the broad U.S. economy. And what's happened in Tricolor isn't just a mistake or a one-off event, my friends. It's a warning that if things don't turn around for the U.S. economy and soon, it's only going to get worse. If you think a rate cut, 2 or maybe even 3 are going to fix this, not a chance. Right now, I'm changing the way people trade, showing you how to get better signals and put more money in your pocket. Let's take a look at this back test result on symbol SPY. This is from our optimized meta strategy. I want to show you just how amazing it is. Let's look at this. Total return over a 3-year period, 71%, beating a buy and hold strategy. It put out 69 trades with a win rate of 66.7%. My friends, that is unheard of, with a max drawdown of around 7.4%. Now let me show you this compared to an unoptimized strategy. This one put out by my buddy Jay Bravo. It's called the Bravo 9. Now, of course, he says you got to use multiple signals. Now with mine, you don't. But look at the difference here. Total return, 51%, missing buy and hold. Only 33 trades. That's half the number with a 51% win rate and the same drawdown. Now, what is my meta strategy? Well, it's an advanced trading system that combines 9 professional trading strategies into a single intelligent signal generator. It has multi-strategy consensus and is optimized for trades over a 10-day period. Now, what I did is I optimized all of those different strategies on a per security basis, and we're going to take this to the next level here soon. And again, right now you can get in on this at no additional charge. Now, how do you do that? Well, you got to sign up for one of our reports. Now, if you want to trade against the machines, sign up for CTA Timer Pro. You want to trade momentum indicators, then you want to sign up for Momentum Timer Pro. Either way, you get the daily report for either one you sign up for, and the signals from that report on top of those meta strategy trades. You get my opinion on the best trades, risk control levels, full tracking of all our open trades and returns, a weekly update, and here's the best part of all. You get a 30-day free trial. All you have to do is grab those links in the description below and use a coupon code for your free 30-day trial. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.